Hi everyone, on this channel I strive to give you an alternative view so that you can make your own due diligence and you are informed about both a negative as well as an optimistic view about Chinese economy. And in this case I want to speak about some new data points here because of course currently everything in the news is around Evergrande, that they are bankrupt, about real estate collapse in China and the weak economic outlook. Let me say so much about Evergrande. I think that's kind of a false flag here because the actual event already happened months ago when actually Evergrande was not making the payments on some of the bond payments that were due. And now the latest news regarding the bankruptcy filing is actually just as much as a legal process. And so not really news itself. But anyways, let's jump into this economic data here, which is the change in GDP compared to the second quarter of 2019, where you can see that the Chinese economy is actually doing quite well. It's 19% up, and the US economy is also doing quite well, up 7.6%. However, this gives you a little bit more of a macro view here of the prospects about Chinese economy not growing as much anymore. Well, yes, they had their dips also because of COVID, and reopening may not be as strong as some analysts have wished that it would be. However, it's still growing at around 5% this year and is adding 30% of the world growth. That's just one thing that I shared in my Patreon community, which, by the way, you can also, of course, become a member if you like to support this channel and get such daily insights. What I've also shared is this article here about the China contagion. I shared this article because it's essentially given us also a different viewpoint, because currently, of course, Chinese stocks are falling, but the real indicators regarding whether or not there's systemic trouble or if we should really be worried about the Chinese economy, for example, credit default swaps and so on, are at low levels. So this author here is concluding actually that despite the fact that we see the China high-grade bond going down, that's the US dollar index, the China aggregate bond index, that's the red line, is actually just going as usual and normal. And also the Chinese yuan is only trading normally against the Japanese yen. So it's all down to the Fed actions and the high interest rates. By the way, I also did a video the other day about this double whammy that's currently hitting Chinese stocks due to the fact that the interest rates are high and investors and funds basically have to risk off and sell some of these assets, including Chinese stocks. But again, this author here is questioning the narrative out there that there is systemic risk. For example, the volatility isn't up that much and Chinese finance stocks are also doing quite well. He also argues that China has a large surplus in trade balance and the savings in percent of GDP are up high. And so he concludes that it's a simple fact that countries with enormous trade surpluses and very high savings rates don't usually facing a financial crisis. Also, the Chinese government does have the resources to cover for dodgy local government debt, and well, if they choose so, they could act. And the banking system has vast resources to issue new loans. All in all, this falls very well into my own view that I think we may not really have to expect a large stimulus for the Chinese economy. Once again, if you look at this data, it rather seems that China is at the normal trajectory and the Chinese government possibly doesn't seem that there is a need for a large bazooka type of stimulus that we see in the West sometimes. Instead, they will most likely support some particular specific sectors, growth sectors such as EVs and AI and chip development and stuff like that. Invest in the future, and along with the government, that's usually where I see it's going to be successful, and I think that will be the way forward. And so we may see targeted stimulus, but not the bazooka, in my point of view. You can also watch my video with Tom Hayes, who is a bit more bullish on the overall stimulus and the entire economy. But I also say that in case that there will be a systemic risk, for example, a real big bankruptcy of another real estate developer or systemic risk, then the Chinese government will step in and bail them out. But until then, I think China is switching to a new growth model, and that's not propping up the real estate sector anymore. So that's it. Just my views, an alternative view. I hope you liked it. If so, smash a like, subscribe to this channel, and consider becoming a patron. Thanks for watching, and see you in my next video.